So we start there. We start from where we left it last time. So what did we do last? What were we doing? Subsequent measurement. Subsequent measurement. Subsequent measurement of financial instrument. Yeah. Subsequent measurement. I will see. This is measurement after recognition. This is measurement after initial recognition. This is measurement after initial recognition. Yeah. That is after we initially measure the financial instruments, then how do we subsequently measure it? How do we subsequently measure it? Then we start with financial assets. Financial assets. Financial assets. As you see, financial assets are classified into two categories. Financial assets are classified into two categories for purposes of subsequent measurement. For purposes of subsequent measurement. For purposes of subsequent measurement. Number one, financial assets. Financial assets measured at fair value. Financial assets measured at fair value. That's the first classification. Financial assets measured at fair value. And below that, you can see long term. Still available for sale. Available for sale. For sale. Financial assets. Are measured at fair value. At fair value. Are measured at fair value. With fair value changes. With fair value changes. Reported to other comprehensive incomes. Reported to other comprehensive incomes. Into brackets, the valuation reserve. The valuation reserve for financial assets. You note that it is the entity that classifies them. That is, there are those designated to be measured at fair value. Then the issue is, are they long-term? Those long-term financial assets, they are also referred to as available for sale financial assets. We measure them at fair value. Fair value is said means market value, with the changes in fair value reported to a evaluation reserve. Evaluation reserve for financial assets. That means we create an evaluation reserve. Remember, there is also the other evaluation reserve for property, plant, and equipment, and other intangible assets. We have those ones. But also we create another one for these financial assets. Then we also have the short-term ones. That is short-term, or you can see held for sale, held for trading, held for trading financial assets. Held for trading financial assets are measured at fair value, with fair value changes, reported to P&L, reported to profit or loss account. The profit and the loss account. So here, there are those that the entity may acquire them for trading, for speculation. Yeah, there are some entities which will buy short-term instruments to sell them when price goes up, or maybe for management of cash. When you have excess cash, you should acquire those short-term marketable securities. They are the ones we are calling short-term marketable securities. You acquire them because there is surplus cash. Then when in need of cash, you do what? You sell them. That is a way of managing cash in financial management. But in accounting, we see we have a short-term investment. We classify them under current assets. That's why we are calling them short-term. And at each year end, we measure them at market value, with the changes in market value from one year to the other, because it must change. We report it to the income statement. So we have those financial assets measured at fair value. And we said the best evidence of fair value is in an active market. If not that, we use the valuation techniques like discounted cash flow techniques. Then we have the second category. Second category, we have financial assets measured at amortized cost. Even before that, there is a note here, and B, upper two. Those measured at fair value include equity investments. All equity investments are measured at fair value. That is, if you have an investment in shares of a company, those ones, there is no other option. We measure them at fair value. Yes. Then we have financial assets measured at amortized cost. Amortized cost. Financial assets measured at amortized cost. That's the second category. The second category. And what do we mean by amortized cost? And amortized cost means it is equal to the amortized cost of a financial asset is equal to the principal. These are loans. They are investment in loans and debentures and loans. So we take the principal amount plus interest cost minus any form of repayment, the installments paid or interest paid. That is what we mean by amortized cost. Yes. That is, the interest cost refers to what? All the costs associated with that borrowing or that investment. And how do we calculate that interest cost? So you can say interest cost. That is what you call finance cost or finance income in case of investment. Interest cost is measured using or is calculated using the effective interest rate. The effective interest rate. And effective interest rate, effective interest rate, effective interest rate is the discount rate, that exactly discounts the future cash flows, of a financial instrument, to its net carrying amount. Full stop. So that discount rate that exactly discounts the future cash flows to the net carrying amount of a financial instrument is what we call the effective interest rate. That is the rate that will capture all the costs associated with a debt instrument. Yes. So you can say the debt instruments are to be measured at amortized cost unless they are designated to be measured at fair value. Unless they are designated to be measured at fair value. Debt instruments are to be measured at amortized cost unless they are designated to be measured at fair value. First, unless they are designated to be measured at fair value. Yes. All debt instruments. Because here, these financial instruments are either what? They are either equity investments or debt instruments. Then we go to financial liabilities. That is, how do we subsequently measure financial liabilities? How do we subsequently measure financial liabilities? And we say short-term financial liabilities, short-term financial liabilities, are measured at fair value, through profit or loss, measured at fair value through profit or loss, measured at fair value through profit or loss, full stop. Then all other financial liabilities, are measured at amortized cost. 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 Full stop. Example. Full stop. Example. Full stop. Example. So we can go to an example. Example. And let us look at what was done last sitting. Question 5A. Last sitting, question number 5, part A. Question 5A. There we have a financial instrument question. We have a financial instrument question. Question 5, part A, we are given on 1st January, question 5A, last sitting. On 1st January 2019, Dodoma Limited issued 1 million board instruments with a face value of shillings 100 at a market price of shillings 95 million. Board brokers charged fees totaling shillings 1.8 million in relation to the board issue. The boards carry a coupon rate of 5% and are redeemable in 3 years at face value. Dodoma Limited wishes to account for the board using the amortized cost method as per IFRS9. However, there is some confusion about how the boards should be accounted for. The cash received from the board issue of shillings 95 million has been recognized as an non-current liability. The broker fees of shillings 1.8 million were deducted from the carrying amount of the non-current liability. The coupon payment of shillings 5 million has been expensed in arriving at the profit before tax. You see, if you look at that paragraph, however, that is what they did, is it? That is how they accounted for this board, this company, Dodoma Limited. Now the question is, did they do it right? Is it? Did they do it right? We are not answering them that one, but show them how it should be done. What is that? Because there is no way the examiner will give you a question and also give you an answer, is it? Yes. Because this is now the answer they did. That is how they did it, is it? Because this is the answer as per Dodoma Limited, is it? Now, as per you, is it the answer? What is that? Yes, give the answer. So we are given the effective rate of interest is 7.62%. The coupon interest payments are made at the end of the year. Required, demonstrate how the board issue should be accounted for in the books of Dodoma for the year ended that 1st December 2019. That means we don't require this paragraph, is it? of however. That is not the question, is it? Yes. Yes, the way they did it, we don't want it. But we can show how it is supposed to be done. Then compare with how they did it, is it? Yes, compare with how they did it. So demonstrate how the board issue should be accounted for in the books of Dodoma Limited. So this is a financial liability, is it? To be measured at amortized cost. Okay, not that way, but the way we have written our notes, they are enough. We have done enough to answer that. So let us start. Let us start as what we have written. What we have written. One, how do we initially measure financial instruments? Initial measurement, because that is the starting point. Then subsequent measurement. That is simply what is being tested. Initially, how are they supposed to measure this? Then subsequently, it is November 2020, question 5. Yes, you can imagine that small question giving you 10 marks in an exam, isn't it? Just by remembering one. Initial measurement. Initial measurement. Although in an exam you don't write all of this, is it? In an exam you give the exact answer, is it? You don't start writing initial measurement. Just give the answer, because you are applying what you have learned. So initial measurement. What did we say? What did we write? Initial. We wrote last time, is it? Yes. All financial what? Instruments are to be measured at fair value plus or minus transaction cost. Full stop. That is, if anybody remember that, 2 marks. 2 marks, just by remembering, because there is no way you can subsequently measure without first recognizing the item in your books, is it? So initial measurement should be equal to at fair value equals fair value plus or minus transaction cost. This board, fair value is how much? Fair value of this board is equal to what? Is equal to, that is, now you have to read again, is it? It is pretty specific. Everything is provided unless you don't read. Yes. If you don't read, you can't get it, is it? It is written how much? Imeandikwa pesa ngapi? The first paragraph, I said, however, you see question, you are told this is the way they did. Like now I can say, the way you said is 100, but is it 100? No. It is how much? Yeah? It's 95. Yes, that was the first error. Whoever wrote 100 lost it. It is 95 million. Plus or minus transaction cost. Do we have transaction cost? Yes. We have board brokers charged fees totaling 1.8 in relation to the board issue. So that means when this company issued this board at 95, it was purchased at 95, they already incurred issue cost, is it? Amounting to what? 1.8, is it? So whatever is they received, they paid. That cost to be charged against what? The value of the bond. So that means we are not to add but subtract 1.8 million, because it is on the side of the issue. If it was on the side of the buyer, the investor, that the investor is incurring cost to purchase a bond, then it should be added. Yes. Because the total cost of an asset should be purchase cost plus cost to acquire it, isn't it? Any other cost. That's why we are saying plus or minus, because financial instruments are on either to the issuer or the borrower. So that means it is equal to 93 200. Whoever got that got 2 marks. Yes, that is added like that. Just by remembering your value plus or minus transaction cost. Is it? 2 marks. Or you can estimate fair value. What is that? Or you can estimate. Yes. Suppose you are not given all that information. You are given a limited, Dodoma issued a bond, 1 million bond, with a face value of 100 at a market price. You are not given the market price. With a face value of 100 million, full stop. Then the coupon rate is 5%. It is redeemable in 3 years at face value. So you omit that statement where you are given at market price all the way together with brokerage costs. What's that? Suppose you are not given the market price together with the transaction cost. How do we estimate fair value? What's that? We can estimate the fair value. And we said we estimate fair value by use of various valuation techniques, is it? And one of them is the discounted cash flow technique. So you can use that method. That is the common use. When you discount future cash flows, the future cash flows related to this bond includes what? Future cash flows. It includes one, annual interest, is it? You can see the bond carries an interest rate of 5%, is it? Yes. That is the coupon rate. It means this borrower will be paid 5% of the face value. Yes, face value means 1 million bonds with each a face value of what? 100, is it? That gives us 100 million. And that means annually they will be paying what? Per annum, 5 million. That is one of the future cash flows. Then there is the redemption value. Redemption. Yes, this bond is to be redeemed after 3 years or at the end of 3 years. Which means that it will be redeemed at what? At face value, is it? Face value of 100 million. So at the end of the 3rd year, this company will pay 100 million. That is that. 100 million to the investor, whoever gave them that, whoever purchased those. So what is that means these are the future cash flows. Annual interest and repayment of the principal, is it? Because this is the principal amount. 100 million. So what is the present value? So fair value equals present value of future cash flows. I'm doing this because in another question, it will not be given that market price. It will be required to estimate by discounting, which means we discount the 5 million, it's an annuity, is it? For 3 years. Using the effective interest rate. You can see we are given the effective interest rate, 7.62%. So we say 5 million multiplied by present value interest factor of an annuity, 7.62%, 3 years. So what is that annuity? Annuity factor plus At the end of the 3 years, they will receive or they will pay 100 million multiplied by present value interest factor 7.62% 3 years. That is a single repayment amount. And you should get the fair value. 5 million times 1 minus 1 plus R. Our R is 0.6. It is 1.0762. Power minus N. N is how many years? 3 years. Divided by R, 0.0762. So that is the annuity factor, 3 years, plus 100 million, 100 million times 1.0762 to power minus 3. That one. And we get what? What do we get? So you get 93 million. 93 million. 201. 440. So you can see, you can estimate it. Yeah. The one given is 93, 200. But still, you can estimate it that. And you can see it's a good estimate. Yeah. The difference is 1,440. Yes. If, in fact, whoever gave this one, first digit is how to get, then rounded off those things to eliminate a lot of complications. So if not given this, the transaction cost and the fair value, you estimate. You estimate, you get it like that. Then after that, subsequent measurement. Subsequent measurement is at amortized cost. Subsequent measurement at amortized cost. Yes, subsequent measurement is at amortized cost. Subsequent measurement is at amortized cost. So we have subsequent measurement. Subsequent measurement is at amortized cost. So what do we mean by amortized cost? It is simply you prepare an amortization table, amortization schedule. Amortization schedule. Yeah, that is an amortization schedule showing the year, showing the opening balance, balance brought forward, showing finance cost. The finance cost. This is the borrower. That finance cost is the interest cost, calculated at the effective interest rate at 7.62%. And that one we take to P and that is what we expense. That is the cost of the loan. We will analyze it. Then there is interest payment. Every year they are paying 5 million interest paid. And you are seeing, you can see we are given the interest was being paid at the end of the year. Yes, so that when discounting, you're discounting, you see, the ordinary annuity, is it? Instead of the annuity due, is it? Because there are cases where interest is paid at the start. So that then we get the closing balance. Balance carried forward. That balance carried forward is the amortized cost. It is the amortized cost of the loan. It is the amortized cost of the loan. So we start year one. Year one is year what? Year one, this is year 1st January 2019. So as at the beginning, we recognize 93. Use which one? 200. Yeah. If you use that, the balance at the end will be there. You won't go to zero. If you use the exact one, because this is the exact one, the balance will be zero. That's how. Yes. So we have that finance cost. Whichever you use, the difference is so negligible. We marked both. Whoever did it this way, whoever did it this way. Yes, just like that. So this gives you what? 7.262% of basic cost, and the interest rate is 5 million. So this is equal to how much? 7.62% of 93,200,000. You get what? 7 million. 101, 7101. 8. So this plus this minus this, you get what? That is how to calculate the amortized cost. It's the principal plus interest minus any form of repayment. You get this one. It's a loan schedule. So this plus this minus this, you get what? Right? 5. 301. 840. That is what will appear in the balance sheet. And this goes to the income statement. So you can see you are given what they did. The 5 million was taken to the P&L, is it? You know, that is very low, is it? Yes, that is very. Even the 95 and the 1.8 is very low. We will see that. Then 2020, you have 95, 301, 840 as the opening balance. So plus interest minus repayment. Repayment is still 5 million annually. And by the way, that is the answer. The examiner did not require other years, just the first year. It is demonstrate how the board issue should be accounted for in the books of Dodoma Limited for the year ended 31st December 2019. UEFA prepared this 1, 2, 3, 4. Each was 2 marks. That is 8 plus the 2, 10. As that was there. That is how generous these people are, is it? It's in the way. So long as you know this way, how do we initially measure, is it? Then subsequent measure, amortization schedule we have been prepared, is it? Since the start. Since we started. So the others are just doing for the sake of doing. But that was the answer. So is it the same as the however statement? Is it the same? It is not the same. We will see the double entry. I want to show you the double entry. We see whether it did record it, right? Or no. So this is equal to how much? 7.62% of 93, 95, 1, 40. You get? 72, 62. That's that. So this plus this minus this, you get amortized cost at the end of the year, which is equal to what? 97, 563, 840. Good. Then 97, 563, 840. 7.62% of this, you get what? 74.34, 365. So amortized cost balance at the end of the third year equals upper 100. Multiplied. 89, 9, 71, 205. Yes, you can see it can't give the exact. But if you use the one we discounted, it will go to exactly what? Although that is not a problem. At least you can see it's going to 100 easily. The difference is negative. So if you add this plus this plus this is then what we can see is the total cost of this. What's that? The total cost of this board. The total cost. Total cost equals this total, which is equal to how much? 21. 7, 98, 205. Because it's also not exact. The total cost is 21. Now we can break it down. That is, this total cost of this loan is what has been amortized. What's that? It has been amortized over the period of the board. So this cost is made up of what? This cost is made up of 1, the total cost of the board, total cost. We can break it down. It's made up of annual interest. The annual interest, which is 5 million times 3 years. That is 15 million. That is one of the components of total cost, followed by the discount on issue. Discount on issue. Yes, this board had a face value of 100 million, is it? Yes, you can see we are paying at the end of the 3 years 100 million, is it? It's deemed at 100. But they issued it at 95 million. What's that? So we can say it was issued at a what? At a discount. Yes. A discount of 5 million. That is a cost. Because you receive 95, you will pay 100. What's that? So that's a cost to the borrower. And finally, the issue cost. The cost of issuing, which is equal to 1.8. That comes to 21,800. Yes, it is this one. You can see it's not exact because of that rounding off. Such that this total cost is what is amortized. That's why we call the method amortization. It is amortization of the cost of the bond over its life. What is that? Because we can't take 1.8 to the P&L as a cost of 1 year, or the 5 million, no, or the 5 million, or the 15 million. It should be spread over the life of the loan, because this loan will be used in that business over that period. So that means it is a cost to the whole period, which then we amortize. We amortize over that period. That way. So how do we record? How do we record? Or how are they supposed to record? Journal entries. Journal entries. Journal entries. So that we see, were they right? Were they right? Such that the first year, or initially, they received the money, is it? They received what? 95 million, is it? So they were supposed to, that is on issue of the board. On issue of the board. On issue of the board, they received 95 million. They must have debited cash book, is it? Cash book with the 95 million. Then they incurred a cost of 5 million, the discount on issue. That one, you debit the finance cost account. It's part of the cost. It's part of interest cost. You debit there. And the credit entry goes to the financial liability. Financial liability, or simply a bond, which is a financial liability, 100 million. That. Then they paid issue costs. With the issue cost, with issue costs they incurred, they are supposed to have debited the same finance cost with 1.8 million and the credit cash with 1.8 million, because that was paid. So you recognize the issue cost as well as the discount as a cost of issuing the debt instrument. Then with annual interest, you will be paying 5 million annually every year. So number 3 with annual interest. Number 3 with the annual interest. They are supposed to debit finance costs. That account still with the 5 million and credit the cash flow. Because they are paying annually 5 million. So every year for 3 years, that entry will be done. Such that the liability or the bond account will remain with a balance of what? And for 3 years. At the end of the 3rd year, you pay, is it? Debit the bond, credit cash. Then this finance cost account is the one which will be, it will be changing from year to year. Finance, if you happen to show it, finance cost account, you'll find that we are saying first year with the discount debited. That is, we show bond. This financial liability is the bond account. Bond. 5 is, that's what I've said. We have written that one. Debit the finance cost. You credit. You debit the finance cost. You credit the bond account. What's that? Then, with the issue cost, you debit here. That is cash flow. Cash flow. 1.8. You credit the cash flow. What's that? Those are the cost of this bond. Then, with annual interest, you debit finance cost, you credit cash book again, is it? Cash book. With 5 million. So if it is year 2019, all that are supposed to have been debited. What's that? Then you credit. What is the total amount? That is what? This is 11,800. 11,800. So of this 11,800, how much do we take to the P&L? How is that? Because finance cost is an expense, isn't it? Of that, for the first year only, how much do we expense? We expense this one. This that we have calculated. You debit P&L, you credit this account. So profit and loss account. And that is equal to what? 71,01840. That is why we were preparing the schedule. This is what is expensed. So what is the balance carrying forward? It is 11,800 minus this. You get what? You get what? Huh? 4,698,160. That is what you carry forward to other years. Balance brought forward is 46,98,160. Then this year you pay 5 million. Debit this account with 5 million. You credit cash flow. Then expense how much? You debit P&L with the interest cost. That is now this 72,62. 72,62,000. You debit P&L, credit here. So what will be the balance carried forward to be expensed the 3rd year? So this is 96, 98, 160, 96, 98, 160, minus 72,62,000, you get what? 24.36. Huh? 160. That is what we bring down the value of balance going forward. 24.36, 160. So again, you pay 5 million interest, you debit here, you credit cash book. Then how much do we charge to PNL? 74.34, 365. PNL is 74.34, 365. That's it. And you should have a zero balance. So, but as you can see, this is 74.96, 160. There is a slight difference. It's due to how the law is. If you do it exactly, you will get the right thing. So this is equal to what? That should be expected to be. But that is how the recording should take place. That's how you deal with the double entry for that. Now, if you look at that, however, is it in agreement with what we have done? Is it? No, it is not in agreement. So all what they did was wrong. Yeah. They recognized 95 million as the liability. They deducted, yes, 1.8 million. 95 million is not the liability. The liability is 100 million, is it? Because that is what will be paid on maturity. That is what is payable on maturity. So even recognizing 95 as a liability, that was not the correct amount. The correct amount is this 100. Then amortize the issue cost and the discount and the annual interest. I think that has covered everything to do with such a board. Everything to do with such a board. So the answer was this first line and this one. So this one there, that first line. Then another example. Another example. Go to September. Go to September 2015, question 3. Question number 3A. Question 3, September 2015, question 3A. Question 3A. September 2015, question number 3A. So if you read, you happen to read, we are given Galvin Limited purchased a zero coupon bond for shilling 600,000, redeemable in 5 years on 1st January 2014. The effective interest rate is 10%, and the bond is carried at amortized cost. So this is a 0 coupon rate. It purchased this bond for shilling 600,000, and it will be redeemed after 3 years. Required valuation of the bond to be reflected in the statement of financial position as at 31st December 2015. Then number 2, finance income for the year ending 31st December 20, just 1 year, just the first time. So this is a financial asset. It's an investment. This has been purchased. You see, in the question we have just done, that Dodoma issued, is it? So it's borrowed. Now this one, whoever issued, we are not given, but this has been purchased. So this is a financial asset. It's a financial asset. It's an investment in a bond which carries 0 coupon. It doesn't have annual interest. What is that? But it will be redeemed at a premium. Yeah, you can see the effective interest rate is there at 10%, which means it will not be redeemed at face value of the 600,000. And that is still what they paid. They purchased the bond for shilling 600, which means that was the fair value. What is that? They paid that. That's what was paid. We are not given issues of cost. Cost in carrying the process of issue. So initial measurement is what they paid. They purchased the bond for. Subsequent measurement at amortized cost. So you simply answer by preparing an amortization schedule. Amortization schedule. Yeah, a table like the one we have just prepared. That's the question. Amortization schedule. Showing the year. Showing the year. The balance brought forward. We have now it is finance income to P&L, which is being calculated at 10%, which is the effective interest rate. Effective interest rate. Then there is no coupon. So there is no interest received. But let me include the column. Then we'll be able to get the amortized cost balance carried forward. So we have first year is 2014. They purchased the bond for shilling 600,000. That is the initial measurement. Interest to P&L is 10% of this is 60. There is no coupon. So that is 0. So balance as at the end is 60,000. That's the carry list, the amortized cost as at the end. So what was the question? Valuation of the bond to be reflected in the statement of financial position as at 31st December 2015. So this is 2014. What is that? So that means they require the second year, 2015, whereby we have 660 as the opening balance. 10% is 66,000. 0 coupon, and therefore this comes to 726. That is the answer. They want answer to number 1 is 726,000. And the answer to number 2 is 66,000. Just that. That is finance income for the year ending 31st December 2015. 66,000. So just by doing that, you get 6 marks. So if you want to go up to the end, because it is to be amortized for 5 years, is it? Yeah. If you add the others, because we are in class, we can add, is it? 2016, 2017, 20. But in an exam, you stop after determining the answer. So in class, you can do more practice. Yeah, finish that. Eh? So we can say, this is how much at the end of that year. 798, 600. So 798, 600. Then 10% is 79, 860. No coupon, so balance at the end. 878. 878 or 60. And then 878 for 60. 10% is 87, 846. No coupon, but it will be redeemed at what? This plus this equals 966. 966. 306. That is what is payable on maturity. Is it? That is what is payable on maturity. So even if the board was a zero coupon board, it still has a cost, is it? It has a cost. And that cost is this one. Because you look at it this way. You borrowed this, or you purchased a board worth 600,000. After 5 years, you will be paid what? 966, the legal is it? Is that? So the issuer will pay you this, but you gave your money equal to this one. So what's the difference? It is the cost to the issuer, is it? It is a cost. That cost is what is amortized over the life of the bond. So that means the total cost or total income. You see, it will depend total income or costs, which is finance cost, is equal to this, which is equal to what? 366? 306. Yeah. And that 366, 306 is the difference between 966, 306 minus what was initially invested. What's that? So that is what is amortized over the 5 years. So it is the cost of the bond. Even if it carries no annual interest, no coupon. Are we together? So then from there, we go to compound. Compound. Financial liabilities. I call it financial liabilities because it's only on the side of the issuer. It's only on the side of the issuer, not the purchaser. Compound financial liabilities. You see, these are financial liabilities. These are financial liabilities that contain both an equity component both an equity component and a liability component. An equity component and a liability component. Contain both an equity component and a liability component. Full stop. Then you see, IAS 32 requires compound financial instruments, to be split, to be separated, into equity and liability component. Into equity and liability component. First of all, examples of such bonds are the convertible bonds. Examples are convertible bonds, debentures or rolling stocks, convertible rolling stocks, convertible bonds, convertible. Yeah, that is why we are calling them that. It's simply because such convertible instruments, they will give the holder a right to convert them into ordinary shares. And the holders of that such has got a right to convert them into ordinary shares. And also, they may hold them to maturity, such that the issuer has an obligation to pay if they happen to hold them to maturity. That's why we are saying they have an equity component and a liability component. Then you go there, you can see the liability component. The liability component is measured as the present value. It's measured as the present value of the future cash flows. The present value of the future cash flows discounted using the effective interest rate of the board. Discounted using the effective interest rate of the board. Full stop. Then we continue with the equity component. The equity component is taken to be the difference between. The total value of the board. It's taken to be the difference between the total value of the board and the value of the liability component, and the value of the liability component, and the value of the liability component. Full stop. Let me see. After separation of the two components, the liability component is measured at amortized cost. The liability component is measured at amortized cost. Full stop. While the equity component, the liability component is measured at amortized cost, while the equity component remains the same. Full stop. Example. I will give you an example next time we meet. So that marks the end of today's lesson. You can go and revise that till we meet next time. God willing. So bye.